as a business, when we acquire a piece of machinery or a vehicle or some sort of an asset, we're going to record that on our balance sheet as an asset at the cost that we paid for this item. Now, we might have this item for 5 years, 10 years, 20 years, depending on what it is, maybe even longer than that. And we will not change the value in that asset, the dollar amount that we originally booked that asset at, until we actually dispose of that asset and we no longer have it anymore. And as I said, we could have something for any amount of time depending on the nature of the asset. Every asset is going to have what's called a useful life. In other words, how long we can reasonably anticipate that it will earn us money. And we want to make sure that when we earn revenue with the asset that we acquired, that a portion of what we paid for this asset gets recognized as an expense against the earnings that were generated from that asset. And this is really a long way of coming around to the concept of depreciation. Now, I think when most people think about depreciation, they think about the sort of the physical degrading of an item. It's wearing out. And that's really not what we're talking about when we talk about depreciation. What we're talking about is the way that we take the cost that we paid for that original item and we spread that cost out over the useful life of the item, and we take it as an expense little bits at a time in each period and are then able to use that expense against our revenue. Now, many items have value even if there's no real value to us for the original purpose that we acquired the item for. We could sell it, we could part it out, sell it for scrap. Maybe we can sell it to somebody else who, might be able to continue to use it. Maybe they can't afford a brand new one, but our used one might suit their needs just fine. So many assets will also have what's called a salvage value. And so keep in mind that there are some methods of depreciation where we need to take into account whether or not an item has a salvage value or not. We're going to use Rohan and his delivery motor scooters as an example of how we're going to treat these items for depreciation purposes. So we've got Rohan and his motor scooter. They have estimated useful lives of 3 years. And for the sake of argument, we're going to assume he's going to run these things into the ground. They're going to have 0 salvage value at the end. And we've paid $3,600 for these motor scooters. So because we expect that they're going to have 0 value at the end, we're going to spread that cost of $3,600 out over the entire useful life of these motor scooters of 3 years. And so because there's no salvage value, the depreciable cost of those motor scooters is the entire $3,600. And so in order to determine how much depreciation expense we take each period, we take the depreciable cost, and if we had had a salvage value, we would have subtracted it from the cost, but we don't. So we're going to depreciate the entire cost. We're going to divide that by the estimated useful life. And in this case, it's 3 years, but we're going to do it monthly at 36 months. And so simple math tells us that we're going to have $100 a month of depreciation for our motor scooters. Now, as I said, we are not going to touch the value in the delivery equipment account. So that's going to remain at its value until we no longer have these motor scooters anymore. So what are we going to do? How are we going to make this adjustment? And the answer is we're going to have two different new accounts. The first one is what's known as a contra account. And it's called accumulated depreciation, and in this case, delivery equipment. So you might have accumulated depreciation, office building, accumulated depreciation, delivery vehicle, accumulated depreciation, factory equipment. So you can have, you're going to have an accumulated depreciation account for all of these major assets. And so what we're going to do is we're going to make an adjustment, a credit to the accumulated depreciation account every month for the 36 months that we have these motor scooters. And so what this will serve to do is when taken together, the delivery equipment and the accumulated depreciation equipment account, that will net us after the first month a carrying value for these, or a book value of $3,500. So because the $100 credit will reduce the overall carrying value on our books, even though we don't touch the original cost of the delivery equipment itself. And if that's confusing, I apologize, but hopefully it will start to be clear. So, I guess the other thing I should add, and your slide reminds me of, is that the book value, or this carrying value, has nothing to do with market value. If it's got dents in it or it's in showroom condition is irrelevant in this calculation. All we are doing here is spreading the cost that we paid for this item out over the useful life. So we may be able to sell it for more, for less, whatever, but that's not what we're talking about. And so, as I also said, this accumulated depreciation account is a contra account, meaning opposite. So it's going to offset the balance that's in the main asset account. Now, here's where things get maybe a little bit more confusing. Okay, perhaps you were good with the delivery equipment and the accumulated depreciation contra account, but of course, you know, we have to have a second entry. We can't just have this credit hanging out there. We've got to have a corresponding debit for our depreciation. And here's where the depreciation expense account comes into play. And they have segregated the depreciation expense into delivery equipment, and you can choose to do that or not do that, depending on how detailed you want your records to be. But you're at least going to have you'll have your main asset, you'll have your accumulated depreciation, and your depreciation expense accounts. Again, not touching the main asset account until we no longer have the asset, but continuing to make the adjustments on a monthly basis, a credit to the accumulated depreciation account and a debit to the depreciation expense account. And I'm going to stop here and go on to the next video for adjusting entries to the general ledger.